Hello everyone, this is Tejashwini Chiranjeevi. In this video, we are going to discuss about the amendments which are applicable for May 2025, September 2025. That is basically for AY 25 and 26 is what we are going to look into in this particular amendment session. Okay, we are going to do the amendments of the direct tax wherein wherever possible, we will try to keep in the comparison of 24 and 25 or else we will directly do the amendments for AY 25 and 26. Okay. So now, with regarding to this one, see the Finance Act which is applicable for your exam would be Finance Act 2024. See, it is very simple. How do you determine which Finance Act is applicable? Whichever attempt exam you are writing. Suppose you guys are writing your finals in the PY 27 and 28. Suppose. Just catch the first one, that is the first year, 2027. The Finance Act of 2027 would be applicable for you. I am speaking in general. Which Finance Act would be applicable? You need not depend on someone clarifying it. You get yourself clarified and you clarify for your friends also. Whichever PY. Remember, now we are speaking about PY and AY only. So, whichever PY you are taking, 2027-28. That 2027, the first year, catch this first year. This will be applicable for your, that Finance Act will be applicable for your exam. PY 27-28 means AY 28-29. No, all of us know what is meant by AY and PY. People, we are doing amendment session here. So wherever possible, I will be speaking in the proper income tax form in a properly easily understandable manner. But AY PY definition, understanding and all, I assume that it is already there. So whichever PY you are taking, catch the first year, that will become the Finance Act which is applicable for your exam. See, which AY are we discussing about? We are discussing about AY 25-26. AY 25-26, which is nothing but PY. Come on, which is nothing but the PY 24-25. Catch the first year, first year, 2024. That Finance Act is applicable. Clear? Now, how the this amendment material is being prepared, or how this amendment material you can get a grip of it, is that whichever amendment is there, that has been recorded in red. Whichever amendment concepts are there, that has been recorded in blue. The concepts, that highlight of that is been recorded in green. That's it, nothing else. Okay, whichever is been caught like this, it means it is for the PY 24-25. It is for the AY 24-25, PY 23-24, and this is for the previous year. That is why it is been caught. If it is caught like this somewhere, it means it is deleted or it is updated. Understanding? It is deleted or updated. Based on this small point, let's start our amendment point here. The first and the very important amendment is going to be under section 115 BAC. Listen. It is going to be in section, what it is going to be in section 115 BAC. We are going to call it as a default tax regime on one place, and we can call it as 115 BAC also. Opting out of default tax regime means it is optional tax regime. It is nothing but the normal provisions. What about this default tax regime means 115 BAC, concessional tax rate. All these are the interchangeable names. People, we will be having some names. See, if your name is Rahul, you will be having some other nicknames. Similarly, like Chinnu, Sonu, Monu, so many nicknames you would be having. Similarly, for 115 BAC, we will call it as default tax regime and we will call it as concessional tax rates. Different names being used. Okay, opting in for default tax regime means you are opting for 115 BAC. That is what the line, that particular line in your exam means. See people, in AY 24-25, you had this, that is up to 3 lakh, it was nil. 3 to 6 lakh, it is 5%. From 5 to, that is 6 to 9, it was 10, 9 to 12, it was 15, and this was the earlier provision, that it was in AY 24-25. In case of AY 25-26, if it is up to 3 lakh, it is going to be nil. 3 lakh to 7 lakh, 5%. 5 lakh to 10 lakh, 10%. 10 lakh to 12 lakh, 15%. 12 lakh to 15 lakh, 20%, and above 15 lakh, 30%. So basically, how to remember this particular point is that, see here, catch this 3 lakh rupees. 3 lakh is nil. However, last time also it was nil only. Now also it is nil only. No problem. 3 to 7 lakh. See, the difference is coming up to 4 lakh here. The next difference between 7 lakh and 10 lakh is 3 lakh. Next, the difference is 2 lakh. And then 12 lakh to 15 lakh, however, you guys would be already getting the grip of it. If you are able to do till year, automatically you guys will do for year afterwards. So 12 lakh to 15 lakh, 20%, and above 15 lakh it is going to be how much? Above 15 lakh it is going to be 30%. It is going to be how much? 30%. See here, 3 to 7, it is 5 lakh. 5%. The percentages are same, people. See, first of all, up to 3 lakh it is nil. 5, 10, 15, 20, 30. 5, 10, 15, 20 and 30 over year. What about year? 4 lakh, 3 lakh, 2 lakh. Difference I am telling you. 3 to 7. Difference between that would be 4 lakh. 7 to 10. Difference between that would be 3 lakh. 10 to 12. Difference between that will be 2 lakh. And difference, and later on these two you will be able to do. That is 20%, and for above 15 lakh it is going to be 30%. Clear? And this material, this amendment material has prepared in such a way, wherever there is updation, wherever there is amendment involved, that entire concept is being recorded in this amendment. So the red point only speaks about the amendment, all the other points are same. Okay. So let's try to understand this, whatever amendment we are recorded over here with example. Wherever relevant, we will take up example, people, not to worry about. Wherever it is possible and wherever it is relevant, we'll take up example. Okay. See, in case of, if you suppose in example 1, you are having 1 crore 12 lakh 50,000 as your income. And now you are suppose this is your total income, NTL. And the total tax liability for AY 25-26 under default tax regime, how you are going to calculate? Up to 3 lakh, it would be nil. 3 lakh to 7 lakh, the difference is 4 lakh. 4 lakh into 5%, it is going to be 20,000. 7 lakh to 10 lakh, difference is 3 lakh. 3 lakh into 10% is 30,000. People, I'm assuming you guys already know to calculate this tax liability. This is amendment video, people. I'm repeating again. 10 lakh to 12 lakh. If you want a further clarity, there are other videos in my channel. You can go and watch that for the better clarity of calculation of the tax liability. Here we are doing the example and the amendment. Remember, 10 lakh to 12 lakh, it is going to be 30,000. 12 lakh to 15 lakh, it is going to be 60,000. How? The difference between these is 3 lakh. 3 lakh multiplied by 20%, 60,000. And 15 lakh and 1 lakh 12,000, 1 crore 12 lakh 50,000, whatever the difference of 97,000, whatever the difference that you could see here, and that difference into 30%, you would get your solution. Clear? Understanding, everyone? And after doing the basic, after doing the tax liability, add the surcharge. It is exceeding 1 crore. Exceeding 1 crore under 115 BAC. The surcharge that would be applicable is 15%. So I am adding up the surcharge, adding up HEC, and you are going to get your tax liability. I hope you are understanding this. Everyone? Clear? Great. So this is with regarding to the amendment in your 115 BAC for that matter. Okay. So now let's move forward. The next amendment you have is in your domestic company. People, this amendment comes in every AY and every PY. Okay, it comes in every year. I'll tell you how. See, AY 25-26, what are they stating? If the turnover or the gross receipts, if it is in PY 22-23, if it is less than or equal to 400 crores. See, every year this amendment comes. Suppose take in PY 24-25, they have stated it should be less than or equal to 400 crores in which year? In PY 21-22. This is in 22-23. It means every PY, this PY which is relevant is 24-25. Correct? Whichever PY you have, okay, 24-25, go backwards for 2 years. Go backwards for how many years? 2 years. This particular one, catch hold of this 22-23 PY, whichever year you take here. This is for PY 23-24, no. Go backward for 23-24, 2 years. It is going to be 22-23, it is 21-22. Correct? 23-24, you are in right now. Catch this one. Every year this amendment happens and you have to go backward and catch this last preceding the previous year, go preceding. That is last to PY, last PY, last immediately preceding the PY, the last PY. That is the PY 22-23 you are going to take, and whatever the points which you have seen here, that is nothing but PY 24-25. If your turnover or the gross receipts crosses this 400 crore, then it is going to be 30%. That is the tax rate that would be applicable. If not, the tax rate that would be applicable would be 25%. Clear? If your turnover is less than or equal to 400 crores, repeat after me. If it is less than or equal to 400 crores, 25% only, yeah, no problem. If it is in any other case more than that, 30% of your total income would become your taxable. That is, it become your tax liability for your domestic company. Why is that? What is the reason for that? People just think logically here. If you tell the assessee, no, take PY 24-25 only. PY 24-25 is what we are thinking. What percentage you need to apply? In order to say what percentage is applicable, you are not looking into the current year turnover to say whether it is 25 or 30 people. You are looking into the turnover of 20 to 23 to say 25% or 30% taxability for the relevant PY. Correct? So what does it mean? If the gross turnover or the gross receipts in that 20 to 23 or 400 crores, it means if the income tax department allow the assessee, you take for the current year only, you take current year turnover only instead of this one. Suppose if they would have given like this only, respective year's turnover only you take, can I say there is a chances, it is not they will do, there are chances that the data can be hampered or manipulated. See, your turnover has crossed 4.5 crore and the option which is given and the income tax department has stated you have to take for PY 24-25 turnover in order to say 25-30%. What will this fellow do? Intelligently he will try to decrease his turnover to 400 crores so that he can show 25% instead of paying 30% on the taxes on the profits. He will do that. Hence the department told, array, we will not give all such things. You take PY 20-23 turnover. If that turnover is exceeding 400 crores, you apply for 25%. If it is not exceeding 30 crores, you take over year only. That is what the reason behind that. Okay. See, after considering over year, PY 22-23, suppose, let's take one simple example we'll take. Relevant PY, PY 24-25, the turnover is 415 crores. Okay. Relevant PY, your actual turnover is how much? So much. But in PY 22-23, your turnover was 220 crores. Tell me whether 25% is applicable or 30% is applicable for PY 24-25. 25% is applicable. Why? Because even though your turnover has crossed 400 crores in relevant PY, but we need to look into the turnover of PY 22-23 in order to say whether it is 25 or 30% people. So it is going to be how much? 220 crores. It is going to be 25. For 415 crores, it is going to be 25%. Clear? Done. Great. So people, for foreign company, earlier in AY 24-25, it was 40% of your income was your tax rate which is applicable for the foreign company, but now they have made it, they have decreased it to 35% of your income. Basically in AY 25-26, for foreign company, the tax liability that would be applicable would be 35%. Clear? And in undisclosed sources of income, there's a small explanation which has been inserted. That is for the cash credit, unexplained loan or borrowing. Okay. Where, see, in case of the cash credit, there's a small explanation which has been inserted. Where in case of unexplained loan or borrowing, when some amount is there, where some so credited consists of loan or borrowing or any such amount. See, what happens if you are having any unexplained loan or borrowing, some amount is credited as your loan. Okay. After the loan being credited, if you are able to answer, if you are able to give a possible explanation for that loan amount and be able to give the possible explanation about the loan amount to the assessing officer and is satisfied, then he will not consider it as undisclosed sources of income. If not, he is going to consider the undisclosed sources of income. Okay. So the next point comes is the unexplained share capital or the premium. So in this case, where in case of the unexplained share capital or the premium. So just to consider, there is a closely held company. There are two companies, okay. One is a closely held company here. And this company is applying for the share. It is providing for the share application money or the share capital or the share premium. Basically, it is providing the share capital money or the securities premium over here. Suppose now if the company is able to offer an possible explanation, and if that company giving the explanation, now the assessing officer is satisfied, then he will not consider it as an undisclosed sources of income. Otherwise, he is going to consider it as an undisclosed sources of income. However, where that explanation, where that amount is so credited, if that is credited by a venture capital fund company, wherein it is already regulated by a SEBI guidelines or it is already registered with SEBI, then these provisions won't be applicable. Otherwise, it would be applicable. Okay. Now, see, very important amendment has happened in this section 112, 111A, 112, 111A, basically in the capital gain section. And whatever the changes that has happened and whatever the amendment that has happened, with example, we are going to understand once we get into the respective chapter amendments. Let's go in a series. Let's not jump anything. Okay. In case of salary, there is a one cute changes that has happened, and it is very important, which is nothing but the standard deduction. What is it? Standard deduction. This standard deduction is nothing but section 16 of the salary chapter gives standard deduction. All of us remember gross salary you will have. Below that gross salary you are going to give a standard deduction. Before it was 50,000, now it is 75,000. Remember one thing, people, those who already have this material with you, those who already have shared this material with you or who have taken that material from the Telegram channel, please make these respective changes. AY 2526 under section 115 BAC, it is not there in the material which is uploaded. I will be uploading a revised material that along with the questions which we'll be doing in this amendment material. But those who didn't have these changes, please to write in this in your material. Okay, please take a print of it here, print of this amendment notes or something, because amendments, majority of your questions in your exams will be covered from the amendment concepts only. So please make sure you are having a very hold of the amendments. AY 2526 under section 115 BAC under default tax regime, you can take how much as the deduction? 75,000. Under AY 2526 you can take only 50,000 people. Remember, you can take only 50,000 rupees. This is going to be very important. Please, I'll repeat, standard deduction under normal provision, optional tax regime, normal provision, it is going to be 50,000. Under default tax regime, it is going to be how much? It is going to be 75,000. It is going to be how much? 75,000. Clear? This is going to be very important. Those who did not make the changes, please make these changes correspondingly over there. Okay. And in this case of, in the PGPP concept, you have few amendments over here. See, wherein the employer is contributing. There is a section called as 80CCD. Okay. This section, for the pension scheme, employee will make a contribution on one side and employer will make a contribution on another side. Two contributions will be done. Employer is making contribution on the behalf of employee and employee is making his contribution. His contribution which is made, we will see that under the respective deduction chapter. But the changes of the amendment has come in the employer's contribution, wherein that fellow employer contributing up to 14% of the salary. Okay, salary here means basic plus DA, and DA, this is going to be in terms only, forming part of the retirement benefit, in terms only. Okay, salary plus basic plus DA in terms. It is 10%. Before it was 10%, now it is 14%. Okay, excess of 14% is going to be disallowed. Let's try to understand this concept with an example. See, this same point whatever we have seen, let's try to understand this with the example. Let's consider the salary for the employee purpose. Salary components include basic plus DA plus HRA and other allowances. Array people, but for the understanding of this salary, for the understanding of salary under this section 36(1) clause 4a, salary includes only basic plus DA in terms. On that 14% we are going to allow as deduction. Correct? So it is going to be only basic plus DA in terms. These two are not considered under this definition calculation purpose. Employer has contributed how much? 1,50,000. Very well. So salary for the purpose of this one is basic plus DA in terms. This two is going to be how much? 10 lakh. How much is the contribution which this fellow employer has already made? 1,50,000. But how much is actually allowed? Salary, 14% of the salary, no. So it is nothing but 1.4 lakh. Everyone. And employer contribution is going to be 1,50,000. Allowable is going to be 1,40,000. 1,40,000 is one allowable, but this fellow has already paid 1,50,000. How much is going to be disallowed? The disallowed portion will be 10,000. That is excess of 14,000. Whatever you have recorded is only 14,000 here. No, excess of 14,000 is only disallowed here. Making sense, everyone? Clear. In case of section 37, residuary expenses, residuary concept, you have one small amendment which is recorded. That is, see, there is a point wherein it states, if you are paying any penalty for the prohibition or breach of contract, it is going to be allowed under income tax. But if it is breach of law, it will not be allowed under income tax. That it will be disallowed. What are the points that are covered over here is recorded in these 4 points. And one point is extra included here to settle the proceedings which is initiated with respect to contravention under law. See, basically you have contravened certain provisions as per some law, not only income tax, any law for that matter. Some law you have contravened, and in order to make it right, you are paying some proceedings, you are making some payment. No, it is not in terms of penalty, but it is in some terms you are proceeding and you are paying that amount because you contravene certain provisions. Even that will not be allowed under income tax as deduction. That is what this point means. Clear? Done. Next, very important amendment is going to be section 40B. See, section 40B clearly states, if you are having any interest, that is basically what interest and to what extent remuneration, to what extent interest which should be allowed under income tax. Okay, interest will be allowed up to 12% per annum, simple interest it will be allowed. Excess of 12% is going to be disallowed. Okay, remuneration to non-working partner, directly it will be disallowed. Array, that fellow is not working only. You are paying salary to that fellow and taking deduction under PGBP in income tax. Will they allow it? No. And you have another partner. Good fellow is working partner over there, but you are not recognizing it in deed. That is whatever remuneration that you are paying, that is not you have not recognized in deed. Again, disallow. You will not be allowing it under income tax. Now what happens? That fellow is a good fellow, working partner. You have authorized the deed also, but relates to an earlier period. Array, it doesn't relates to the respective year. Current year, it is not allowing, it is not being recorded as per relevant year. It is recorded as per some earlier years. That is, it will be disallowed. Clear? Now, remuneration, okay, working partner, so you are giving, no, fine. Good working partner without is authorized in deed. It is for the relevant PY only. Okay, fine, you are going to take that remuneration, but there is certain changes that has happened. See, earlier, AY 24-25, suppose, let's consider you had some book profit of 8 lakh. Okay. Out of this 8 lakh, up to 3 lakh, you were giving 90% of this 3 lakh or 1,50,000, whichever is higher. Excess of that, out of this 8 lakh, 3 lakh you have considered here, on that 5 lakh rupees you were taking 60%. Okay, that is what you were doing earlier. But now, out of this 8 lakh, first you are going to show this 6 lakh as the first, on the first 6 lakh. Array people, common sense here. 8 lakh, in order to earn 8 lakh over there, first you should earn 1 lakh, then 3 lakh, then 5 lakh, then 6 lakh, then only 8 lakh, no? So on the first 6 lakh of the book profit, or in case if it is a loss, take take 3 lakh or 90% of the book profit. See, 90% of the book profit means 6 lakh which you have taken here. Maximum of 6 lakh of 90%, whichever is higher you will take. Out of this 8 lakh, 6 lakh you've already considered here. Remaining 2 lakh is what you should take now. So that remaining 2 lakh you have to take 60% of the book profit here. Clear? 60% of the book profit you need to take. See now. 3 lakh or 90% of the book profit, whichever is higher. Suppose, what if this is only 4 lakh here? This is only 4 lakh. Okay, it is not 8 lakh and all, it is just 4 lakh. You will take the entire 4 lakh, my dear people. 4 lakh into 90%. 4 lakh into 90% you will take. Correct? 4 lakh into 90%. Whatever the answer you would get. How much would you get 4 lakh into 90%? You will get 3,60,000. So this 3,60,000 rupees or 3 lakh, whichever is higher. Which will you take? 3,60,000 is higher. That will be allowable remuneration. Okay. Suppose, what if your remuneration is only 2,40,000? You will allow entire 2,40,000 over here. What if it is 3,60,000? What if it is 4,40,000? Only you will restrict it to 3,60,000. Clear? We'll take this and understand this with the of an example here. See, Rao and Jane, a partnership firm consisting of two partners, reports a net profit of 17 lakh before deductions of the following items. Salary 40,000 of each partner, two partners is there. Depreciation you are providing, interest on capital at 15% per annum, and the amount of the capital interest eligible for 5 lakh you are taking. Interest capital amount which is allowable for which you have taken, which a partnership firm has taken, is 5 lakh. What is the interest they are paying? 15%. Tell me people, how much is the interest which is allowable? Only 12% is allowable. Okay. So excess of that is going to be disallowed. We are going to do that very soon. You guys will do it now only. 5 lakh. 5 lakh into 12% is going to be how much? 60,000. So 5 lakh into 12% is going to be 60,000, which is going to be allowed as deduction. Depreciation on plant and machinery, are you going to allow it as deduction? Yes, obvious. 40,000 of each partner. Let's see how much is the salary or remuneration which you have taken. 40,000 rupees per month multiplied for each month. How many partners are there? How many partners? 2 partners. Correct. How many partners are there? 2 partners. So Rao and Jane, a partnership firm, these 2 partners, they are having net profit. Remember, this question they have told, these points have not been adjusted. That is, this salary, this profit, whatever they have, this is before adjustment of all these things. So we can directly take and subtract whatever is relevant. Correct. In order to find the book profit, we are going to do it. See, first of all, book profit of the firm they have asked. Let's do the book profit. Net profit you have, 17 lakh you have, no. 17 lakh you will take. And whatever is allowed, 1,50,000 you will subtract. People, remember, if this was after deduction, then the situation might have been different. Okay, this is before. So out of the 17 lakh, this was supposed to be allowed as deduction. You have not considered, so you will take it as deduction, 1,50,000. Clear? 12% up to 12% it's allowed as deduction. We are going to allow it as deduction. So out of 17 lakh, 1,50,000 and 60,000 is gone. 2,10,000. So 14,90,000 becomes my book profit before remuneration adjustment over here. Done. Now, what is the actual salary paid? 9,60,000. This information we already have. Let's do the computation. We already have how much is the book profit, that is 14,90,000. 14,90,000, out of that 6 lakh of the book profit, 90% of that 6 lakh or 3 lakh, whichever is higher, obvious it is 5,40,000 is the answer here. On that balance of book profit, see, out of 14,90,000, you've already taken 6 lakh here. Remaining is how much? Remaining is 8,90,000. Out of this 8,90,000, 60% of the book profit you are taking, which is resulting in 5,34,000. Which is resulting in how much? 5,34,000. And this 5,34,000, we are going to take it, and we have taken the total over here. This is the allowable remuneration. Till this you can allow. Suppose if your remuneration which is allowed under the calculation, suppose if it was 12 lakh, you would have restricted it to 10 lakh 74,000. But in the question, it is just 9 lakh 60,000. So what you will do? It is just 9 lakh 60,000. No. So the entire amount of 9 lakh 60,000 is allowed because this is below or within 10 lakh 74,000 point over here. Understanding? Clear? Very, very important amendment, people. I'll tell you, 40B is the most important amendment. Okay. So now, the next amendment, let's try to understand in the capital gain chapter, that is coming under section 46A. People, there is a concept called as buyback. See, buyback is very simple. You are holding a share of a company. And that company is having, let's consider 1 lakh outstanding shares. 1 lakh shares is there in the market. That company is trading 1 lakh shares. And now they're thinking, let's do one thing. Let's do the buyback of some 10,000. Based on some calculation, they have got that number. 10,000 shares will buy back. What they will do in case of buyback, they will make an announcement in the public stating that we are doing the buyback. Those who are opting for buyback can opt through your demat account. Okay, now I opted. There is a option which is available. I ticked it and my shares have been bought back. The point was, now the buyback has happened. They have cancelled certain number of shares from the market existence. I have got my buyback. I have got my money which they have quoted for the purpose of buyback. Now the situation is done. Let's look into the taxability point of this buyback. See, if the buyback of the shares were happening for the domestic company before 1/10/2024, remember this point, before this date, it is not on. It is on. It is not on. This is before 1/10/2024. Exactly 1/10/2024 is included in this date, on or after 1/10/2024. Okay. And the company were paying how much? See, if I'm supposed to pay you buyback of how much? 100 rupees. Suppose buyback amount. Total amount which I should pay you because of buyback is 100. I would deduct 23.296% from that 100 rupees which I'm supposed to give you as the amount. I was deducting so much and I was giving the remaining amount to you. Now the people started quarreling. What is this, sir? I am a student. I'm just having certain income. I have applied for I have allotted, I got the shares from the demat account, and that is my only source of income, and I'm not even coming under the 3 lakh rupees, 5 lakh rupees bracket. I'm coming under basic exemption limit. People started crying. You are though deducting 23%. We are not even coming under 5% bracket here. So the department was like, so the government was like, wait, we'll do one thing. On or after 1/10/2024, if the buyback happens, we'll do one thing. Whatever the amount which you have got as the buyback amount, treat that as income from other sources in your income. Entire amount, treat as dividend and show it under income from other sources. No deduction available. This is in case of section 57. We'll come back to it. Take that entire amount, show it under income from other sources. Close. Now we are telling, how can that be possible here? That was coming under the capital gain earlier. No. Now we are telling income from other sources. Earlier it was capital gain. Now what to do for the investment money? That is the cost which I incurred for buying that buyback shares. For buying that shares. Suppose you have the buyback money which you have got is 100. Okay, you have shown this under income from other sources. Close. You are telling, I paid 40 rupees here to buy that shares. I was holding it. It became 100. Then I sold. Then I gave it for buyback. So the department was like, don't worry. To whatever extent capital gain which was concerned earlier, we'll do one thing. Whatever is the value, whatever is the value, the consideration, whatever you were calling it for, take that as nil. Everyone, the consideration whatever you would be received would be considered as nil. That is zero, nil. Now take the cost, whatever the cost which you have, subtract that. This will automatically result in a capital loss. It will automatically result in what? It will automatically result in capital loss. You take that capital loss, set off as per the set off and carry forward provisions, close. Don't worry for life. Understood? See, whatever the consideration which you have got, mark it as nil. And whatever the difference between the value of consideration and the cost of acquisition which you have, treat it as capital loss. Enjoy. You get capital loss on one side, set it off and carry forward as per the provisions which is applicable for the set off and carry forward provisions, and the show it as income under income from other sources. Close. Clear? Okay. So section 47, transactions which is not regarded as transfer. See, section 47 stated very simple. If my mother or if my father was giving a property as a gift to me, that was not considered as transfer at all, even though there is a provision of movement of capital asset from my parents' name to my name. Because it was considered as gift, no, my parents would give it as gift, it was not taxable. Correct. Earlier what happened, this name of individual or HF was not there. So it was just treated like this. Any transfer in AY 2425, any transfer of capital asset under a gift or irrevocable trust by any person. I have written here any person. See, person includes individual, AOP, HUF, BOI, everyone. It includes everyone. Intelligently, department included this term individual or HUF. Now, if the transfer of capital asset happens through a gift or a will by an individual or an HUF for that matter, it is not going to be considered as transfer. Clear? It is going to be not going to be considered as transfer. Individual or HUF, any transfer capital of individual or HUF for that matter, it is not regarded as what? Transfer. This is going to be the ancestral properties, people, not in general sentence, not in general case. This you have to read with the main provision of section 57. Transactions not regarded as transfer. When it is being transferred by our parents in the form of gift, will, etc. In that case, individual or HUF being transferring it to us, it is considered as not considered as transfer. If it is not a transfer, we already know it is not a capital asset. Clear? Section 48 is specifically told, we will do the computation of capital gain. That is what section 48 told. Earlier, there was a concept of indexation. Remember, the entire concept of indexation is not removed. Entire concept is not removed. In certain minute place, the indexation concept is still there. Okay. Let's see where is that minute place. See, if the transfer has taken place, suppose, let's look into this, section 112. Okay. Section 112 states long-term capital gain tax rate which was supposed to be in general. If the transfer had taken place before 23/7/2024, remember this date very, very well, like you remember your birthday or like you remember your boyfriend's or girlfriend's birthday. Whatever you do, you remember this one. This one. Where the transfer has taken place before 23/7/2024. Before that. Exact date is it going to be covered over here? No. Exact date is covered here. Exact date is not covered. So before 23/7/2024. You had any unlisted shares of a closely held company for that matter. The transactions were as it is, people. There was no amendment. There's no amendment here. The amendment comes here. Okay, it was as usual. See, for non-corporate, non-resident foreign company fellow, 10% was there. For other assets, 20% with indexation benefit was there. If it was listed securities or zero coupon bonds, 10% without indexation you could have taken, 20% with indexation benefit which you could have taken. This is whichever is beneficial. Any other asset was there, 20% with indexation. Life was very simple. Now they wanted to make it as complicated. How? Where the transfer has taken place on or after 23/7/2024. Now, after this date, remember, this is the transfer that has taken place. That is the sale, barter, exchange, relinquishment, extinguishment, whatever you call it as. Sale that has happened after 23/7/2024. On is also included here. But if you have purchased the asset before 23/7/2024, remember, if you have purchased before, it is not on exact this date, before this date, if you have purchased it and you have sold it on this date, and of what land, building or both, all these are and clause, remember. One clause, 2, 3. This is our AND clause. If you have transferred it after 23/7/2024, if you have purchased it before 23/7/2024, it is land, building or both. Either land or building, or it can be both for that matter. And you are an individual or an HUF, that too you are a resident fellow, you have option of 12% without indexation or 20% with indexation benefit. Only and only you are a special person and special good person as per the income tax option is given, individual or HUF. Company doesn't have this option. Company comes under other assessees, AOP comes under other assessees, BOI comes under the other assessees, firms also come under this one. That is, other assessees 12.5% without indexation, but individual or HUF resident 12.5% without indexation or 20% with indexation benefit, whichever is more beneficial for you. Clear? Whichever is more beneficial. What if it is land, building or both, and if it is acquired on or after 23/7/2024? See, this is land, building or both only. It is transfer has taken place after and now it is if acquired on or after 23/7/2024. Acquired on or after. That is, you have purchased it after 23/7. Suppose you purchased it in September 2024 and you have sold it in October 2024. Remember one thing, it is going to be 12.5% only without indexation. You don't have any other options. You don't have this option of 12.5% without indexation or 20% with indexation. Okay. In case of any other assets, you have straight 12.5% without indexation benefit only. Okay. Let's try to understand this one with an help of an example. See here. Let's take a understanding. Let's take an example. 25 lakh 20,500. One long-term capital gain example we have taken. Okay, let's consider long-term capital gain which you have got is 25 lakh 20,500. If you apply 112 with the concept of without indexation benefit. Suppose now you have acquired it before 23/7/2024. You have sold it after on or after 23/7/2024. You are an individual. You have transferred it on let's consider 1/10/2024 and you have purchased it in before, that is you have purchased in somewhere around 97 98 1997 and 1998 you have purchased it. So purchase has happened before and transfer has happened after. Okay, and you are an individual and you are selling land over here and this is land. Okay, so in this case what happens, 25,20,500 is, this is without indexation benefit and this is with indexation benefit. If I am speaking about without indexation benefit over here, this 25,20,500 without indexation you have to pay the tax of just straight 12.5%. How much is the tax liability that you would get? So much. Very well. Suppose you apply indexation benefit. Indexation benefit means you are going to do this. That is 5 lakh into year of transfer 363. I hope you already know to calculate the indexation solution. That is how to calculate the indexation. Based on that assumption, I am moving forward. Okay. See, net sale consideration which you got is 43 lakh for 35,500. Indexed cost of acquisition which you got is 5 lakh multiplied by 363 into divided by 100 over year. That is, this is the year of transfer, this is the year of purchase, and whatever the cost which is incurred you have got over here, LTCG you got so much. With the indexation benefit you have to pay 20%. Now an option is given to you. Tell me which one you are going to opt for. Are you going to opt for this or are you going to opt for that? Obviously, you are going to opt for whichever is beneficial. Either it might be 12.5%. In this case, I have just taken the number to be same. It is not necessary that the numbers should be same. The numbers can be different here. Okay. This is an example for this one with indexation and without indexation, how you would do. Whatever the points which you are seeing forward and all those things are there in my Telegram channel. The link will be provided in the description. You can go and join over there. Okay. Now, if I am speaking about section 112A, which is the brother of 112. See, 112A and 111A both have similar changes. 112A stated See, if you're going to sell a shares, if you're going to sell listed shares, if you're going to sell units of business trust, or if you're going to sell some equity oriented funds for that matter, and those are long term over here. How do you determine the listed shares to be a long term? How? If it is held for a period greater than 12 months, long term, less than or equal to, if you are holding it for a period less than or equal to 12 months, short term, more than 12 months, long term. You have held it for some 2 years and it has become long term, and you have transferred before 23/7/2024 only. The tax rate that would be applicable for you is 10%, and the long term capital gain which you got is 96,000 only. In that case, you wouldn't even pay a single rupee tax, because the long term capital gain, that limit has been increased from 1 lakh to 1,25,000. Before it was 1 lakh, now it is increased to 1,25,000. What if it is on or after 23/7/2024? It is going to be 12.5% on LTCG, which is exceeding how much? 1,25,000. 12.5% on LTCG, which is exceeding 1,25,000. Clear? If it is before 23/7/2024, 10% exceeding 1,25,000. On or after 23/7/2024, 12.5%, which is exceeding 1,25,000. Okay, it is 10 and 12. Remember, these two are 1,25,000. What if you have capital gain of 1 lakh in which you got it before, and 1 lakh which you have got it after? Total capital gain which you have is 2 lakh. Are people, this is cumulative one amount, 1,25,000 for 1 year per annum. Don't take it to be 2,50,000 in total. It is 1,25,000 rupees in total. Okay. So now, in case of 111E also, you have a similar amendment you have. What is it? The date of transfer, if it is before 23/7/2024, if it is going to be 15%. On or after 23/7/2024, it is going to be how much? 20%. It is going to be how much? 20%. Clear? Let's try to understand this with an example. Okay. See, this fellow, Mr. Mithun, this fellow purchased 100 equity shares of Good Money Co. Limited. Okay. On 1/7/2007, and at what rate he had purchased it? At 1,000 rupees per share. Company allotted him bonus shares also in the ratio of 1:1 on 1/12/2023. This fellow received a dividend of 10 rupees in 2024-25 PY. He has sold all the shares on 1/10/2024. People, this is after 23/7/2024, on or after that date. So here it is going to be 12.5%, remember, at the rate of 4,000 rupees per share, and prepaid brokerage of 1%, and this STT 0.02%. We are going to ignore it. We are not going to consider STT as the expenses under your capital gain. It is going to be considered as expenses only in case of your PGBP, that if it is considered as your business. Okay. Compute his total income and the tax liability for AY 25-26 if Mr. Mithun pays tax under default tax regime, assuming that he is having other income of 8 lakh. He is having other income here as well. So, fair market value of the shares of this Good Money Co. Limited on 31/1/2018 is going to be how much? 2,000. They have given the fair market value also. They have given the other informations also. Okay. See now, people, with regarding to this one, computation with regarding to this point, you have LTCG over here on one side, and with regarding to the bonus shares which you are issued, this is going to be STCG, short-term capital gain. And you have other income, two other income. One is dividend and one other income mentioned in the question. Based on this, let's do the computation. The gross sale consideration, 100 shares you had, 4,000 rupees you multiplied, 4 lakh rupees you have recorded, fine. And brokerage which you have given is 1% of the sale consideration you have given, fine. What is your net sale consideration? 3,96,000. And this solution, whatever you are recording over here, this explanation, if you want the solution, this explanation for this one, it has been separately posted in your the other videos of my channel. You can go and watch over there. We are sticking to the amendments here, so let's stick to the amendments only. Okay, your actual sale cost consideration is 1 lakh. Here, whichever is lower, you are going to consider. So, 2 lakh or 4 lakh. Fair market value is on this date, or actual sale consideration, whichever is lower, 2 lakh. And actual sale consideration or the answer which you have selected, whichever is higher, 2 lakh you will take it, and LTCG is 1,96,000. Bonus shares which is given is 1:1 share. You had 100 shares, you got 100 shares now, and the brokerage which is considered you are subtracted. Net sale consideration is so much, and a bonus shares you are going to consider the cost as nil. You don't pay anything out of your pockets, no. So you have provisions over there for bonus shares, that is there in the capital gain chapter. And the short term capital gain is how much? 3,96,000. Income from other sources, you had 10 rupees which is given as dividend out of 200 shares. 100 which you have bought original shares and 100 is your bonus shares. So total you have 2000. Jai, finish. Other income you had 8 lakh and the total is 13,94,000. Now comes the point. See, LTCG and STCG are special rates of tax. So you have to tax it separately first before putting the income under the your slab rate. Correct? So now first what you will do is that 112, 12.5%, that whatever 1,96,000 rupees you had here, long term capital gain. On this you are going to apply how much? 12 point. On this you are going to apply 12.5%. That is how much? 71,000. 1,96,000 you are going to apply. But you have 1,25,000 exemption, no. LTCG up to 1,25,000 rupees, exceeding of that only taxable at 12.5%. That is what you have recorded. And here you don't have any such exemption. So 3,96,000 into 20% you have taken, 79,200 you have considered. Tax on the remaining income, 8,02,000. How did you get this one? Out of 13,94,000. You subtracted 196 considered here, 396 income considered here, remaining it's 8,02,000. Based on people, my dear people, these paying tax under default tax regime here. Remember this point very well. So we have considered the tax liability as per the default tax regime. If you would have done under normal provisions, I would have taken under normal provisions. I had no problem. So the total income was so much, HEC have recorded so much, and the total income is also so much. Clear? So the next amendment is there in the income from other sources chapter. The similar amendment you are seeing in the buyback. Okay. Whatever the income which you had recorded it under income from other sources, deeming it to be a dividend, no, that is nothing but the concept which is covered over here. That is a deemed dividend. Whatever is the buyback which you have before the domestic company, before 1/10/2024, you had no problem. You have just recorded it as buyback close. But now if it is on or after 1/10/2024, you will be treating it as your deemed dividend under section 2 subsection 22 clause F as your deemed dividend. And there is no section 57 applicable, that deductions which you got under section 57 will not be applicable. So deemed dividend you are going to call it as under income from other sources and tax it as per your respective slab rate. Okay, no deduction is allowable. That is what it means. Deduction under section 57, I told you. See, in case you have some dividend income, suppose, or let's consider you have some dividend income of 10,000. Okay. In order to earn this dividend income, first and foremost, you should have invested some money in your equity shares. After investing, let's consider you have taken 1 lakh rupees loan from the bank, invested that money. For that loan, you are paying interest now of, let's consider 18,000 rupees per annum. For per annum, how much you are paying? 18,000 rupees. But out of that, because of you taking loan only, because of you paying interest of that, you are getting that remuneration also. Sorry, you are getting that dividend also. So certain amount should be allowed as deduction for you, no? So how you are going to allow that as your deduction is going to be very simple. To whatever deduction you are taking, take 20%. Whatever the interest that you are paying, take 20% of it. So that is interest expenditure cannot exceed 20% of your income. Okay. Whatever deductions, first of all, let's take whatever interest you are paying, or 20% of your income, that is nothing but 2,000 over here. So whichever is lower, see, restricted means cannot exceed, means this is the point. That is nothing but your dividend, 20% of your dividend income, or your actual interest expenses, whichever is lower. In short, we can write like this. Correct? Whichever is lower. But this deduction you cannot take in case of 222F. That is, you cannot take this in case of the dividend, deemed dividend, which is arising in case of buyback under 2 subsection 22F. If possible, remember the section number 222F. Okay, clear. Family pension, yet another important amendment which can be given in your full-fledged computation question or in your MCQ is that sum which is equal to, basically you are getting a family pension, okay. Normally your normal provision was, that is 33.33%, nothing but 1 by 3 in general. You can call it as just 1 by 3, okay. 1 by 3 of your income, that is 33.33 percentage, or 1 by 3rd of your income, or 15,000. This was in case of your optional tax regime, that is normal provision. In case of default tax regime, they have increased it to 25,000. You doing the solution as per default tax regime, take 33.33% of your income or 25,000, whichever is less. You doing the question as per the normal provision, take 33.33% or 15,000 rupees, whichever is less. Simple as that. Simple. Now, when we are coming to the deduction chapter, certain amendments are there. That is, which is coming under section 80CCD. See, in case of 80CCD2, you have seen a point. See, 80CCD means the contribution for pension scheme made by employer, made by employee. Employee contribution is coming under 80CCD1. Employer contribution is coming under 80CCD2. Okay. Now, government, if it is contributing, it was 14% only. See now, how much of the deduction that you can take from the employer contribution who is making to you. Remember, first of all, in the salary chapter, you might have already studied whatever the employer contributing in your name, it is taxable in the hands of the, included in your gross salary, included in your GTI, in the hands of the employee. Employer contribution included in the hands of employee in your GTI. Later on, you will get the deduction under section 80CCD2. Remember this point. Correct. And in case of the contribution which is made by any other employer, if that employer fellow is central government, you can take deduction of 14%. If that fellow is other than the government, you can take deduction of up to 10% in that case. However, if you are coming under default tax regime, an option, a benefit is given to you, that is, you can take under 14%, not 10%. Normal provision, employer contributing some money in pension scheme of 80CCD2, you have to include that entire income under your GTI first, then take deduction of 10% of the salary or 14% of the salary in case of your default tax regime. Clear? Otherwise, normal provision 10% you will take, easy. Default tax regime, little higher benefits, you will take exemption of 14% under section 80CCD in case of your deductions. Okay. Now, when it is coming up to your salary chapter, that is when it is coming, when it is coming up to your TDS and TCS, you have very, very important provisions, very, very small changes that has been recorded. Wherever there is changes in that percentage, people, for God's sake, remember, you will get questions. Majority of the time you will get questions from those concepts only. So please make sure whatever the changes that has happened in TDS and TCS, you remember every minute detail of that sections. Okay. Under section 192, basically, if I being an employer, I giving the deduction, that is, I giving you salary, I should deduct the TDS and then give the remaining amount to you. Correct? There are certain explanation which has been inserted. See, I am an employee, you guys are rich people, you guys are employer. Okay. Now what happened? I am coming and telling, Array sir, for all my salary you are deducting TDS. I have some loss from income from house property. From that head, I have loss from house property. Where will I go? You are just deducting all my TDS amount. So the employer was like, okay, fine, do one thing. If you have any loss under the head income from house property, you get the details and come. I will take that as a consideration when we are doing the computation, and based on that we will deduct the TDS. Correct? Again I'm coming, sir, what is this, sir? For all my salary you're deducting the TDS. I have the TDS or the TCS under some other sections, sir. You bring those details also. We will consider that for the purpose of calculations of the deductions of the TDS under the head salary. That is what this point means. And this point is going to be effective from the time 1/10/2024. Okay. Section 193 states that interest on securities over here. For this point, with effect from this date, that is on or after this date, if you are going and investing your money and over year, and interest is payable by whom on the floating rate savings bond deposit for that matter, but the interest payable exceeds 10,000 rupees during the financial year, then TDS is supposed to be required. If it is less than that, TDS is not supposed to be. TDS is not required for that matter. All these points you need to read it very, very properly. Okay. Section 194C gave a small understanding with relating to the concept of work over here. Okay. With effective from this date, first of all, 194C is nothing but the section wherein there's a contractor and a contractee. Contractor giving services to the contractee. Deductions of TDS need to be happen. Correct. So, with effect from 1/10/2024, it is clarified that the work shall not include, the definition of work shall not include anything which is given under section 194J. People, 194J, if you're already covering professional services, technical services over there, why will you bring those definition under the definition of work under section 194C? You can deduct a better tax over there under section 194J. 10% you can deduct if it is classified respectively. Why will you bring that? That is what they've stated. Don't bring 194J related explanation of those expenses under 194C. Done? Now. So now if there is any manufacturing or supplying of a product, see basically A and B. Okay. There is some manufacturing supplying of a product based on this fellow is the customer. Okay. This customer is giving a specification. Based on that specification, A should be supplying a product. Okay. Wherein this B is only purchasing certain goods and giving, that is specifications by customer by using the material purchased from the person. B is only giving all those goods to A. Certain specific goods to A. In this case, if this is happening, this transaction is happening, and this transaction is other than such customer or an associate or a customer, basically this is not a related party transaction, then it will not be regarded as work. It will not be regarded as work. If it is a related party transaction, yes, customer associate for that matter, it is regarded as work. Okay. So section 194DA, with effect from 1/10/2024, the rate of tax which is supposed to be deducted is 2%. 194DA states that you are having a life insurance policy. Basically, whatever the amount which you are getting, now you are not coming under the exemptions of 1010D. As you are not coming under the exemption of 1010D, you are supposed to pay the tax. We are going to deduct the TDS. Before it was 5%, now it is only 2%. With effect from means, for God's sake, remember people, this is on or after 1/10/2024. That is up to, if I am considering like this, up to 30th of September 2024. How much is the percentage applicable? 5%. That is what it means. You write this in every question, every point going forward. Okay. See, 194G, you are selling a lottery ticket and getting the commission over here. 5% was the percentage till 30th/9/2024. I have clearly mentioned here to 30th/9/2024. Thereafter 2%. People go in the, thereafter 2% means on or after 1/10/2024. On or after that date, 2%. Okay. If in case of commission or brokerage in general sense under section 194H, so 5% till 30th/9/2024, and thereafter it is going to be 2%. 194IA, you are selling some immovable property over here. Okay. Rich people selling immovable property other than agricultural land. People, agricultural land is not a capital asset at all. You transfer it also, you don't get any capital gain. There is no tax involved. Hence, there is no TDS also. This is other than agricultural land. You're transferring rich people, you're transferring a immovable property. Okay, you're exceeding 50 lakh rupees, you're paying 1% of the consideration of the stamp duty value or this one, whichever is higher. The amendment which is coming over here is going to be, see, suppose let's consider there are multiple transfers. Okay, one property was joint property, some 2-3 people transfer, multiple transferors were there, and one party, that is Mr. D, is getting that property from multiple transfers. Mr. D now is settling the transactions, providing the consideration, 50 lakh rupees for this fellow, 50 lakh rupees for this fellow, and 50 lakh rupees for this fellow. For the purpose of understanding the consideration for the calculation of the TDS, the entire 50 lakh, the total which you have paid for the multiple transfers for one property, that property transfer will be considered as the consideration. What if, suppose there is one transferor A and there is multiple transferor X, Y, Z. Now this fellow is giving 20 lakh, this fellow is giving 20 lakh, this fellow is giving 20 lakh. For the purpose of consideration, we are going to consider the entire amount. That is what this point states. Clear? More than C, provided that where there are more than one transferor or transfer in respect of any immovable property, then the consideration shall be the aggregate of that amounts paid or payable by the transfer or the transferee of such property. Okay, that is what this point means. So section 194 IB, till, that is if the rent is being paid by a certain individuals or an HF over year, payment of that rent happens 5% till this date, and thereafter it is going to be 2%. All these rates are very, very important. See, certain certificate for deduction of tax at a lower rate is now going to be applicable for 194O and 194Q also. See, section 200 speaks about where, how the tax and the other things need to be deducted. See, what is the insertion of that understanding that we can get from this particular point amendment is that there will be no correction statement that will be delivered after the expiry of 6 years from the end of the relevant year in which the statement is required to be delivered. See, suppose you are supposed to provide a statement, that is, there is a no correction statement will be delivered after the expiry of 6 years from the end of the financial year. Suppose a statement need to be delivered in this particular year, PY 24-25. After it is delivered, in the 6 years has been expired, after that you can't go and say, no, I need to make some correction in my TDS statement. You can't go and state all those things. That is what the explanation provided. Clear? And this point is going to be very, very important, people. Before, see, under section 206C1F, before what happened, the sale of this motor vehicle which is exceeding 10 lakh rupees. You have purchased one you have purchased some car, and the car worth is 20 lakh, that is excess of 10 lakh. Now 1% of TCS was collected, close, only for motor vehicles it was had. Now with effect from 1/1/2025, the scope of this section 206C1 has been expanded to include every person being a seller who creates any amount of consideration for that matter. See, now the word, the goods, motor vehicle has been considered. Another point has been inserted in your section stating that other notified goods. Goods will be notified on time by the department, by the act. Whichever the goods which are notified, if that is exceeding 10 lakh rupees, then the TCS of 1% need to be collected from that buyer. Clear? I hope you have understood. If you want this material and the relevant questions material, whatever you have seen, I will be providing that in my Telegram channel. If you are not able to find that, please do text me over the Telegram. I will send it personally to you. And whatever the questions which you have with regarding to the entire direct tax subject, you can feel free to text me over the Telegram in a private chat, so that I will explain whatever the questions which you have towards the direct tax. Okay. Thank you so much, people. We will meet in next video, and all the best for your studies.